Hello everyone, I'm Connor Lokar, Senior Forecaster here at ITR Economics, and today we're going to be going over a couple of our foundational concepts here at ITR, rates of change and leading indicators. These two really amount to our bread and butter here at ITR, and we think that they're very powerful tools in terms of yourself as a business owner and an executive in terms of evaluating your business in a different way. Obviously, you know macroeconomic data is important to your business. You know microeconomic market-based insights are important, but in terms of a first step to get there to that analysis and direct company-based application, we have to start with rates of change. So we're going to go through that at a rudimentary level. So as for any data set, I like to think as rates of change as a step back opportunity where a lot of folks in business are evaluating things by the day, by the week, year to date, average daily bookings, average daily sales, living within each month or quarter within itself. And we like to think of rates of change as an opportunity to step back and take a little bit more holistic view of the business as a whole. So it still starts at that monthly level. So what you're looking at here beside me is a example data set. This is monthly data. Most commonly at the company level, we're leveraging top line sales. That's, I would say, the overwhelming majority of what we analyze and forecast for our clients at ITR, but that's not to say that that's all that you can look at. You can look at bookings, you can look at maybe some volume-based metrics, just by raw number, pounds shipped, total length, anything that you can quantify into a monthly data stream. And it all has to start here because this really lends itself to our cyclical analysis here at ITR, but we have to start adding some manipulations on here to get the data to that next level in terms of usability. So the first manipulation we apply is a 3-month moving total. So this would start to bring it into familiar territory for a lot of you. This is a rolling quarterly sum. A lot of folks just think about the classic calendar-based quarters ending in March, June, September, December. At ITR, we're looking at this on a constant rolling basis. So what this 3MMT does for us here is it really knocks down some of that month-to-month chop in the data where, particularly if you're a project-based business, maybe you're prone to large orders, project-based opportunities, that it can really throw a lot of noise into one month and perhaps at the detriment of maybe either month on the side of it. This 3-month moving total helps massage out some of that noise. So you can see that in this chart beside me here as far as all of a sudden we see that some trend starting to build. It's also going to exhibit any seasonal characteristics that may be occurring within your business. Any of you tied to construction, you're generally going to see a spring into early midsummer, seasonal flowing of volume, and then an ebbing as we move back into the fall and winter months. Retail activity would be the opposite. We tend to see a seasonal flowing of activity, with the onset of the fall peaking at the end of that calendar 4Q timeframe and then dropping off thereafter. So that is one of the metrics we start to pick up off of this first manipulation into this 3-month moving total. So as we track this over time, we can see that this business is clearly rising. We're seeing a general rising cadence here with this 3-month moving total now, most recently at about $17.8 million for this example data set. So you can see there's just a clean sum. For this example, it happens to be a clean calendar quarter, April, May, June 2021, summed together. We then, as we close July's books, we would then kick April off of this calculation, then it would become May, June, July 2021, summing to that next 3MMT data point. So it's always adding a month, dropping a month as the data becomes available for whatever it is we're analyzing and forecasting. So the next step that we take, once we knock down some of that month-to-month volatility, once we start to evaluate some of those seasonal characteristics and norms, where we go from there is generating what I think is probably one of the most powerful internal data points any business can create, which is a 312 rate of change. Now, we call it a 312 at ITR. That's our nomenclature. It's just a rolling quarterly growth rate, a quarter-over-quarter rate of change. Now, as we look at this trend over time, we pick up a lot of utility out of this. We pick up some early momentum signals and markers for a business as we track this 312 rate of change. So we can see very clearly it's been rising for the last several quarters. That rate of change has been moving higher and higher and higher. Last fall, that rate of change was still below zero, but it was rising. So that business was recovering, very likely from some COVID-19 related disruptions in the early mid portion of 2020. And then finally, we got that rate of change. You got its head above water, so to speak, in terms of into positive territory in the fourth quarter, and then through the first 2 quarters of this year in 2021, we've seen a decided uptick in momentum, culminating now in a rate of change of plus more than 35, going on 30 6% quarter over quarter. So this internal marker is basically the first cyclical view of the business, where we're not just tracking daily sales on a dollar volume basis or year to date or month to date sales. All of a sudden we're applying the growth rate, the speed at which the business is moving either backwards or in this case forwards very quickly in terms of this positive growth rate. So the 312 rate of change, this is going to be a bit more volatile than the annualized growth rate I'm about to show you, but it's also has a bit more leading utility for us. It shows us earlier when a business is going to go from maybe a recessionary trend into recovery. In this case, a recovery trend into an accelerating growth trend. And then very likely for a lot of businesses, it's going to start to hint at a slowdown when we see that 312 rate of change ultimately peak and then start to come down. So I personally love this metric, and it's one that all of our clients that we've used this is, once we show them this methodology, it's hard for them to go back. Once you start applying this cyclical methodology to your business, it opens your eyes and illuminates the trends within your business in a very apparent way that shows how you're trending. So we'll take the next step now. Similar math from the 12-month moving total where we're summing, but it is now 12 months, the most recent 12 months. Now you'll see that this is always a rolling calculation. We're not just looking at calendar year sums or fiscal year sums. It is a rolling annualized trend. It's always add a month, drop a month. So you can see now with finalized data through June 2021, in this example, it becomes July 2020 through June 2021. Per my earlier comments, once we close our July books for this personal example, we would kick July 2020 off the train, so to speak, and then it would become August 2020 through July 2021. So we're always looking at rolling trend. And we can see now all of a sudden that data stream, that sum is much smoother than its 3MMT counterpart. All of a sudden there's no seasonality showing up because we're always looking at a calendar 12-month period. So it's going to encompass seasonal low points and seasonal high points. All of a sudden it's distilled very neatly down to that raw core trend of the business. Are we moving forwards or are we moving backwards? In this case, another case of obviously moving forwards. We can see that 12-month moving total bottomed out around the third quarter of last year, and then it's been advancing higher and higher ever since. So we can see that upward movement and momentum is building. So all of a sudden, month-to-month volatility is completely out of the picture. Any seasonal volatility is clearly out of the picture. And then we want to see what pace are we seeing our business grow at through time. We want to know, how quickly are we moving forward, and that brings us to our 12-12 rate of change. That's an annualized growth rate here. It's 12-12, that's our nomenclature, 12 months over 12 months. That's that annualized growth rate. And we can see a very nice positive number here. We can see that is zooming above that zero line. We can see an accelerating growth trend is evident there. We can see that growth rate is above zero and rising after it was actually in recession not too long ago, even in the early second half of 2020 before bottoming out, then moving into recovery in the latter portions of 2020. And then this business found themselves now above zero as we move through the midpoint of 2021. So I'll just pop all these up now so you can see them in relation to one another. And this is very powerful in terms of a methodology. It just changes the way you look at your business, the way that you think about your business over time, where it's a very nice step in terms of extracting some of our bias out of the conversation, extracting maybe some of the day-to-day trials and tribulations of the business out of it. And to my earlier comments, that step back perspective is from a broader, higher level cyclical perspective on the business, where we can see our annualized growth rate. We see that 312 rate of change. You can see that it bottoms out a bit earlier, and then it starts to precede and tell us that rising trend, when it's going to be coming, and then how long we can expect that to last. We obviously see that very favorable plus 36, very nearly 35.6% growth rate there on a quarter over quarter basis for the end of the second quarter. That's indicating to us in the near term, we're going to see some of that upside pressure continue to build on an annualized basis for the next 3 to 5 months or so. Generally is about how much lead time we get out of that quarter over quarter growth rate. But I want to pivot your focus to that 12-12 rate of change and that 12 MMT. That's what really lends itself to forecasting, that stabilized data trend, that 12-12 rate of change. That's your business cycle right there. That is basically what is signifying what historically might have seemed like a very theoretical or hypothetical term, business cycle, where that's your quantified business cycle through time as we chart that 12-12 rate of change. So we've gone ahead and codified the business cycle into 4 different phases. So and we use that 12-12 rate, so that sine wave that you see there in various colorations, that indicates various phases of the business cycle, and that's based on a 12-12 rate of change. So think of that colored line as a 12-12 moving up and down, up and above and below that zero line through time. So the first phase of the business cycle, at least the first one we'll be talking about today, is recovery. So recovery is a very interesting phase of the business cycle. This is where your annualized rate of change is still below zero, but rising. So it's a more and more favorable rate of decrease. We're still moving backwards on an annualized basis. Technically, we're below where we were a year ago, but we've gone from maybe 20% annualized rates of decline 2-3 quarters ago to maybe now 10% or 5%. The bleeding is slowing down. It hasn't necessarily stopped at this portion of the business cycle. But when we find ourselves here, this is where we have to start forcing ourselves back into that more optimistic and aggressive mind frame in terms of different levers we're pulling within the business, where maybe we're starting to respool capacity, bring folks back online. We're starting to maybe think about rebuilding our inventories, which in the absence of rates of change would be the exact opposite of what your gut would be telling you to do. At this point in the business cycle, you've been in recession for quite some time. You're still below zero. You're reluctant to believe that things are going to get better, and you want to wait for the pack to start to move. It feels inherently risky to move in an aggressive direction at this point in the cycle if you weren't watching your rates of change, if you weren't seeing that evident cyclical shift underway. So that phase A is one of my favorite, but probably because it's the most challenging for folks to wrap their heads around in terms of picking up that nuance from a shift from a recessionary trend into that recovery time frame. Phase A then transitions, as it did for the example data set I just showed you, from recovery into accelerating growth, when that annualized growth rate gets above zero and is rising. Each month after the other, we're growing at a faster and faster pace. The pace at which the business is moving forward is gaining steam. We are accelerating. It is, we call it the best phase of the business cycle, because obviously that's where most businesses want to be for as long as possible. I think most people know that this phase doesn't last forever. Obviously, we wish it would sometimes, but it's a time to maximize potential out there in the market. That's when we're seeing our most fertile selling conditions. Our various end-use markets are picking up. This is generally an inflationary time in the business cycle. This is where all those good problems to have generally creep in, where and what a lot of businesses are struggling with right now in the midpoint, transitioning into the latter stages of 2021, where we don't have enough people, we don't have enough product, our suppliers have us on allocation. We can't keep up with the demand, which of course is probably preferable to maybe some of the issues that businesses dealt with during the onset of COVID-19, but challenges nonetheless. Then phase B ultimately transitions to phase C. We never see any particular phase last forever. Sometimes we maybe con ourselves into thinking that it's going to, but eventually phase C comes. And phase C is slowing growth. And there's some difficult nuance in this particular cycle as well, because this one is very hard to perceive as well, where once things start to slow down, if you're not evaluating your rates of change, it may take a while for you to catch on to that, to really tangibly feel that transition of things slowing down. So phase C, we throw the caution sign up there because this is where we start to take our foot off the gas. Where we're still growing, but maybe 2 quarters ago we were growing 20% year on year, and then now maybe we're growing 10%. We're still above where we were a year ago. We're still moving forward, but it's a decrease in the rate of increase in the business. So now the landing gear starts to come out. Maybe we're a bit more diligent about our inventory levels. Maybe at this point in the cycle, generally when prices are generally high, maybe we're pulling back on that capital expenditure, that capacity expansion, or that slew of new hires, because we want to evaluate what does that next phase look like for us. Is it going to be a soft landing where we never actually move backwards and we transition right back into phase B? Or does it turn a bit more ominous where we move into phase D? That is that recessionary phase of the business cycle. This one is probably going to call back the most vivid memories for most folks. It's the easiest to describe. It is where we were, say, with the onset of the 2008-2009 Great Recession. Obviously, where most folks found themselves in the second quarter of 2020 during the COVID-19 downturn. There's little explanation needed here. This is where that recession survival playbook comes out, where it's about battening down the hatches. But there's also opportunities in phase D. If we're going into phase D in a very healthy cash and balance sheet position, we're not over leveraged, there's opportunities. Maybe we're picking up equipment at auction. Maybe we're hiring talent that is being cast off by other businesses that have perhaps were too far out over their skis heading into this phase. So every cycle has its own psychological challenges. It has its own opportunities. It has its own operational challenges and opportunities. But it's important to leverage those rates of change to know exactly where you are in the business cycle. So I want to take you through what I think is an interesting exercise and kind of showing you what that looks like from both angles, both from a rate of change perspective and from a dollar-based perspective. So as a management tool. So this is an annualized data trend indexed, on the y-axis on the right. It is dollar-based, so when we see those blue bars going up and down, that is a revenue trend moving up and down over time. We can see that this business back in the early mid-2000s was in a general rising cadence where, yes, it had some periods of decline, but you'll notice those troughs were moving higher, the peaks were moving higher. This was a business gradually moving upward in the business cycle trend. From a rate of change perspective, that's what you see above there. That orange line is that quarter over quarter rate of change, that 312. That dark blue line is the 1212 rate of change. And just, I want you to notice how that 312 rate of change really precedes any movement in the dark blue line, the annualized rate of change. So when I talked about it as an internal KPI, it's going to give you a heads up for when things are going to get better. So I go to that 03-04 timeframe when that orange line bottomed out, ultimately started rising, upward passing that dark blue line. That was an early heads up for that executive that, yeah, this is just a modest period of decline and we're moving right back into our next growth cycle. Likewise, you'll notice that that 312 rate of change also peaks well before that 1212 rate of change. So this business is seeing, before they notice it on an annualized basis, okay, that rate of change has peaked. It is downward past that blue line. We're moving into our next softening period of the business cycle. So, and you can see the interplay there between the dollar values and those rates of change over time above one another. So a lot of businesses found themselves in this very position in 05, 06, and into 2007, where it was a very nice time, from a macroeconomic perspective for the U.S. economy. It was kind of the final ascent there before moving into the Great Recession. Most businesses were seeing their rates of change ascending. They were seeing their dollar value in particular ascending, and what most executives missed out on was that 312 trend that I just panned into the screen there, where we saw that 312 ultimately peaked for a lot of folks in that 06, 07 timeframe. It started hinting at some downside risks starting to come into the picture, and unfortunately, most folks don't pick up on that. They don't realize that that's occurring, and they're moving forward. They're thinking that times are great. They're going to continue to stay great, and they make decisions based on that. They were hiring people. They were purchasing new equipment. They were purchasing new office space. They were, signing long-term leases. They were loading up on expenses just before we transitioned into the Great Recession. And most businesses saw this phenomena as well. We saw just severe protracted decline in their top line performance, going to that recession survival playbook, laying folks off, drawing inventories down, deferring capital expenditure, maybe even selling assets to stay afloat. But eventually there was a transition there. Eventually, towards the late 09 for most folks, maybe early 2010 timeframe, we saw those rates of change bottom out. Now, I would say that was probably the most challenging phase A transition in recent memory, because it was such a long recession. It was a protracted, folks were just under the weight of that decline, not just for 3-4 months like we saw during COVID in 2020, but 3, 4, 5, 6 quarters, quarter on quarter, that downside pressure. Folks were infected with pessimism at this point in time and either didn't notice or perhaps didn't want to buy in on the recovery trend that was evidenced in all of their 312 rates of change before their business really started to pick up. We can see that 312 bottomed out in that 09 timeframe. It upward passed the 1212 rate of change in that late 2009 timeframe. This executive was getting some rate of change signaling, some momentum markers saying things are starting to get better. Yes, we're still moving backwards, but the rates of change are telling us that things are starting to get better. The bleeding is slowing down, even if it's very hard for us to perceive at this point in the business cycle. And then, of course, thereafter, things started to ramp up in that post-Great Recession timeframe, and folks that were paying attention to their rates of change were able to act early. They were able to hire folks. They were able to make purchases, acquisitions at that business cycle low to gear up for what was a multi-year economic expansion coming out of 2008, 2009. So layering in both of these aspects, really, it takes you from struggling and living in the day-to-day, working inside the business, where you can take a step back and look down on the business to gain that broader macroeconomic perspective. Because once we have those rates of change up top in particular, And we can track those over time, and then more importantly, forecast where they're going. And that'll bring us to our next portion of this content as far as layering in leading indicators to not only see historically where we've been, the short-term signals, but get some of those longer-term predictive data points helping us with our decision-making, making us make better decisions at the right time as far as our markets and the macroeconomy is concerned. So I look forward to sharing that with you next.